Hey, so how to avoid getting audited by IRS? Nobody wants to get that email, like that letter, like IRS, So how do you do that? What are the tips to avoid that? When I talk to an accountant, give me a minute. All right, so this is KG. I'm a realtor with Fairfax Realty in Greenbelt, where we have buyers to buy their dream home and sellers to sell their houses. And we do this in the Maryland, DC, Virginia region. So listen, if you're looking to buy, sell, invest in real estate, contact me below. We'll take care of you. And don't forget to subscribe to the channel. So we're talking about tips to avoid IRS audits, right? So we've been talking about different things that you can do to reduce your tax liability. But with that comes risk, right? So introduce yourself one more time.
Hey everybody, my name is Zopia Olumase, owner of Olumase Accounting and Consulting, and I'm your resident CPA today.
All right, so give us 5 tips that we can take home to avoid IRS audit. So, but before you do that, is that a common thing? IRS audits, do a lot of people get audited?
In the grand scheme of things, no. The answer is no.
Okay.
But there are things that you can do, or you may mistakenly do, that increase your potential. Sometimes it's things that you do, sometimes it's just things you can't avoid that increase, but it's always better to be prepared for it, because an audit, the risk of an audit is greater than, than the percentage of people who's audited.
Oh. Whoa. You said the risk of an audit is greater than the percentage of people that actually get audited.
Yeah, and what I'm really saying is that you could, let's say you avoid an audit for most of your life. You're like, okay, but you're doing sketchy things on your tax return. Mm-hmm. You can get away a lot of the time. I'm not going to keep that from you. However, the one time that you do get audited, the IRS has the power essentially to tax, put interest on their tax and penalize you for years. And all of that penalty can just be balled up in a large sum. And then now you're faced with multi-year taxes, which when faced with that bill, you're likely going to say, I wish I just didn't do it from the beginning.
Okay. Right. So before we go to the 5 tips, how far will IRS go back? Like, how many years are they legally allowed to go back?
I mean, really, it depends on the infraction or the offense. Wow. Let's say in any situation, the IRS can technically go back however far they want. They can find a reason to, right? But generally, the period, I believe, is between 5 and 8 years or something like that. But in some cases, it's limited to 3. But you can see, just depending on the circumstance, it can go from 3 to 5 to 10, right? So I just say, don't get into that.
Don't get into that, right? Yeah. Mm-hmm. Like you said, you may be getting away with some little stuff for a while, but then that one time, it can be serious issue. Yeah. Don't do it. So let's talk about 5 tips. I know you have more than 5, but want to talk about 5 that you can try to avoid IRS audits.
Certainly. And so the first tip is you can expect it. You already can probably guess it. I'm an accountant, and so the major thing is checking your information, your data, double checking your return. I prepare so many returns and I give them to clients to review. Oftentimes clients don't actually review their returns. Now, let's say you're working with a CPA who's not diligent in their work or double checking their work, you put yourself at additional risk. So check your information, check the social security number for yourself, for your children, your dependents, check the EIN numbers for your business, maybe spot check that your W-2s have been properly captured. That's going to save you a lot of headache in the long run.
Okay, that's number 1.
Number 2, it goes without saying, but being 100% truthful at the beginning.
Okay.
Yeah. At the beginning, be 100% truthful, because this is not only going to prevent IRS audit, but it's also going to protect you in the event of an IRS audit. Right.
Okay.
So how the IRS determines whether or not a refund is going to, a return is going to be audited is that they take certain factors in the return and say, does this make sense for a typical lifestyle? Like, do things make sense? So they will look at maybe the industry that your business is in. How many dependents? If you have dependents, are you taking the expected credits or the expected deductions? Or if you're in business and you work from, I don't know, you work from home mostly, are you taking an exuberant amount of deductions in travel or meals or just all these high risk areas? So these things, it's better to be truthful upfront so that you're protecting yourself upfront and on the back end.
Okay.
Yeah. Number three is something that I don't know if you can actually affect if you're being truthful. But when you in those gray areas where you have the option, it's best to be conservative. Be conservative. So number 3 is really keep it simple. Right?
Okay.
Keep
it simple.
Yep. What does that mean?
Yeah. What does that mean?
Yeah, so it's not that you can actually keep it simple, because as you go on in life, you may do things that cause your return to be a little bit complex. But the reason I brought that point is the fact that most returns that fall in this category, where they're less than 200,000 reported income, but they're greater than the national average of income, the returns that fall within that area and are not complex, they tend to avoid audits. So you're going to see audit risk raised when you're making above 200,000 a year of reporting that much, or you're reporting below the average income, and you might be qualifying for that earned income credit type of area. You're also going to start getting more risk if you're reporting a business on your return, or partnerships or investments. Things like that will add to the risk. So if you just by that, you can understand that, okay, if I had simple return, I just worked as an employee, maybe I owned a house, maybe I rented, probably renting, you can see that you'll be less likely to be audited.
Okay. Number 4
is realistic deductions, right? So this goes along with the part that I was saying, that the IRS looks at your whole situation and determines whether or not it makes sense. So I want to bring this point out specifically for my business owners, those people who report Schedule Cs, partnership returns, or S Corp returns. Okay. When you're reporting your profit and loss, it's important to look through those expenses that you're going to be deducting. One, do they make sense? Did I have 50,000 in office expenses, but my advertising cost is 1,000, right? Those things are red flags. Immediately, I'm like, hold up, does that make sense for the business that you're in? Right? Does that really make sense for the business that you're in? And so you got to be able to make those distinctions, or at least get ahead on those things and figure out, okay, was everything in its proper place? And then as an added tip for those realistic deductions for business owners and for everyone, you want to make sure that you have the right support behind everything that you're deducting. Keep your receipts, make them digital, make everything trackable through maybe your bank accounts, bank statements. You can even upload receipts onto a cloud portal so that you can have that support. If you bought a home, keep all of those purchase documents, your closing statements. If you gave to charity or your local church, keep that letter for your contribution summaries, things like that. You don't want to just throw away all of this information. It's going to help you. Okay. Number 5. And number 5 is the simplest of them all. It's e-file your return. You'll be surprised that in this modern day age that people still are mailing in their returns.
Because you're millennial.
Yes.
Okay.
Yeah, so typically what I've seen, there's only 2 reasons that you see people mailing their returns. One, they haven't transitioned to the modern age of e-filing return, or 2, their return might have had, when they e-filed it, they may have had an error, which caused them to have to mail it in. Some errors are required. You have to mail in your return.
Okay.
So that goes back into number one. If you get everything right the first time, or your accountant gets everything right the first time, you can avoid any instance where you have to mail in your return, because that just takes time. It just takes time. So the biggest benefit from e-filing, though, is the fact that the chance for errors and mistakes are far less whenever you e-file it versus if you do it manually.
Oh, okay. Okay. So those are the 5 tips to avoid IRS audit.
But I have a bonus tip.
Okay.
Bonus tip just for those advanced followers is that some accountants and tax preparers offer audit protection.
Okay.
And so you may ask, what is audit protection? Audit protection plans can just be an add-on service that your tax filing company can offer. They guarantee like that a certified tax professional is going to help you understand communication from the IRS, as well as help draft response letters and deal with them efficiently. They're not going to, some accountants are able to offer insurance based on certain things, but that's essentially what audit protection is, to give you some type of support in the event of an audit.
Of an audit, okay. And that's just payable when you file your taxes, right?
Yeah.
Do you do that?
I do a small audit protection, just in which we are in your corner in the event of an audit. We facilitate the communication. Now, if there's any additional fees as a result of it, we're not going to cover that, but we can help you figure out what's the next step or course of action.
What do you mean additional fees? So, I mean, I guess if there's IRS fines, is that what you're talking about?
If they're fines. So like earlier last year, I had a client who basically gave false information, right? And so what we did was we prepared the return, right? But then they got a letter from the IRS, and then the IRS is like, is this correct? And he's like, oh, I can't prove that. And so at that point, there might be additional fees that you could expect. And so that brings me to a very important point when you're dealing with the tax preparer or whenever preparing your returns, is that ultimately you as the taxable entity, the taxpayer, is responsible for your return, for the information, for keeping records.
So your accountant can only go by what you tell them.
Yes, exactly.
All right. So we just talked about 5 tips to avoid IRS audits. Thank you, Zoe. You want to drop your number one more time?
Absolutely. Yeah. Again, my name is Zoe, owner of Olumise Accounting and Consulting. You can find us at olumiseac.com. Or you can just Google search Zokpia, that's Zokpia, and I promise you I'm the only one. If you want to give our office a call, just call us at 301-294-8900.
All right. So, hey, this is KG. I'm a realtor with Fairfax. If you're looking to buy, sell, move, or invest, don't forget to contact us below. Don't forget to subscribe to the channel. So we are on this journey of tax return because tax season. So next time we'll talk about some other thing. Ciao.